Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of cryptocurrency tax audits, why they're on the rise, and what you taxpayer can do to try to protect yourself or possibly avoid an audit. Cryptocurrency law, right? It's a decentralized form of currency, quote unquote. The IRS doesn't treat it as currency. It's not backed by the US government. The IRS treats it as property, so there's a whole different set of rules involving income associated with cryptocurrency. As we all know, there's been a recent surge in value lately of cryptocurrency, and the overall skepticism of the IRS, it's become an increased enforcement priority. There's various protocols. There are the soft letter 6173, 6174, Operation Hidden Treasure, right? J5, and lots of other things on the horizon. Unfortunately, people will be getting nabbed, right? The big Bitcoin fog individual of the purported or alleged owner of the company was nabbed out in Los Angeles. There have been John Doe summonses being issued in Massachusetts and Northern California, things to consider. So when the enforcement priority increases, so does the chance of audit, right? The IRS wants to get down and dirty, figure out what's going on. So here are some key issues and audit risks to think about if you engage in cryptocurrency tax transactions. First, did you pay tax on the sale? Just purchasing cryptocurrency is not a taxable event, right? You purchased it for 10 cents, now it's worth $1 billion. You got to pay tax on the sale. Okay, it's like selling any other property. Did you receive it as income? And this is where it gets a little bit confusing for people. It is confusing, but when not all cryptocurrency transactions are capital gains, right? If you receive it in lieu of cash, let's say as income, then generally you have to report it as income, and then you have to deal with all the headaches of employment tax and all that kind of stuff. You can't skirt all of those issues by receiving cryptocurrency for work performed, let's say, instead of cash or check, right? Did you invest it into an ETF or mutual fund or other foreign equivalent, right? CCOVs and things like that. Income being generated from investments involving cryptocurrency are typically going to be taxed in the current year. Now, if you've got, if it qualifies for an exception, that's great. You'd have to look into each individual type of fund. If it's overseas, then you've got the bigger headache of FBAR and FATCA, PFICs, passive foreign investment companies, especially for funds, and that's where it can get complicated. So what happens at one of these audits? What does the IRS want to know? Well, first, they want proof of transactions. For example, you say you only exchanged 50, maybe through Coinbase or a different exchange. The IRS is going to want to see that. You want to make sure that the transaction record that you have is going to meet or mirror what the IRS has, or else they're going to want you to explain why you've got 800 transactions, but only 50 showed up on the IRS's radar. They want to make sure, of course, at the end of the day, with all of this, they want to make sure that you, taxpayer, paid sufficient taxes to what they allege you owe for cryptocurrency income earned. Was all the income reported, right? If you received it, if it's not showing up on a 1099, if you received it for different reasons like employment or stuff like that, especially independent consulting, they're going to want to see that. They want to see that you reported all of it as income. International and offshore, this is where it gets infinitely more complicated. If it's in a foreign account, generally you're going to have to report it. There's some ambiguity as to what's considered account, what's considered reportable. There's old information from 2014, and I think it was the AICPA who had mentioned something about not having to report it. There's no absolute requirement to report it, but guess what? Recently came out FinCEN, Financial Crimes Enforcement Network 2020-2 notice that said, hey, our goal is to make you report cryptocurrency in foreign accounts just as you would regular money in foreign accounts. So chances are you're going to have to meet the FBAR requirement, FATCA, which is submitted directly to the IRS, possibly 8621 if you have PFIC, and then there's various other issues depending on how that cryptocurrency is being held. If you want to, once you're audited, you can't do one of the disclosure programs. So if you haven't been audited yet and you're concerned, there's various disclosure programs you can consider. If you're willful or just can't certify under penalty of perjury that you're non-willful, you want to consider the voluntary disclosure program, or VDP. Otherwise, there's various non-willful programs available. There's the streamlined domestic and streamlined offshore. Domestic and offshore is based on the residency of the taxpayer, not the location of the account's assets, income, and investments. You've got reasonable cause and delinquency procedures. We have lots of free information available on our main website and our sub websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.